Hello everyone. This video is going to be on corporations issuing common stock. We'll go over corporations issuing common stock for cash or non-cash assets. We'll also go over what preferred stock is. In a separate video, I am going to go over what treasury stock is, but not in this video. So the first thing I'd like to talk about is, and again, bring up your PowerPoint slides. I'm going to work right through those slides. Any of the practice problems I have are right in the slides. So the first thing I want to talk to you about is characteristics of a corporation. All right, so who owns a corporation? Stockholders. Stockholders own a corporation. There could be one or two stockholders. They could be millions of stockholders. Characteristics of a corporation are, so I'm just looking at my PowerPoint slide and I'll go through that with you separately. So it's a separate legal entity. What does that mean? That means that the accounting for the corporation is kept separate from the owners, from the stockholders. Second characteristic is limited liability of stockholders. What does that mean? That means that if the corporation does something bad, you can't sue the stockholders personally. You can sue the corporation, but not the stockholders personally. Transferable ownership rights, that means that if the CEO dies, it's unfortunate, but the corporation lives on. It's not like a sole proprietorship where one person, that business is done if the owner dies, or a partnership, they have to reorganize if a partner dies. Corporation just continues on. Next aspect, lack of mutual agency for stockholders. Again, that means that you can't sue the stockholders if another stockholder does something in the corporation. You can't go and sue the other stockholders individually. Ease of capital accumulation. That means that the corporation can issue common stock. They can get cash by issuing common stock. And I'll go through the risks associated with that. Some disadvantages in the United States for corporations is a lot of government regulation, which is very costly for corporations. Another disadvantage is corporate taxation. So the corporation is taxed, and then when the stockholders receive a dividend from the corporation, they're taxed as well. So that's why a corporation is taxed twice. Again, I'm working right from my slides, so I'm going to hit the next slide. So rights of stockholders. They can vote at stockholders meetings. They can sell stock. They can purchase additional shares of stock. They can receive dividends, if any. So not every period a corporation is going to pay dividends. And I'll have dividends on a separate video as well. And they can share equally in assets remaining after creditors are paid. So a lot of times if a corporation goes bankrupt, the creditors are paid first before the stockholders. Stockholders get what's left over. Okay? All right. So now we're going to go over the vocabulary associated with common stock. So I'm going to go to the board. This is really important that you understand these terms. So what they're going to do in these practice problems is they'll throw these terms right in the transaction. Here's the first term, authorized. So I'm pointing here. So we're going to go over authorized and then I'll go over these on top. So authorized, that's the total number of shares a corporation is allowed to sell as stated in its charter. Okay, so when a corporation goes to incorporate, they go to the state, they are given a charter, and within that charter it states how many shares of stock this corporation is allowed to sell. That's authorized. Second thing to think, never make a journal entry off of authorized shares. Okay? Next definition, issued. What does that mean? That means sold to stockholders. That's stock that's in the hands of stockholders. You will make a journal entry with issued. So issued is sold to stockholders. Here's the next one. Outstanding. Outstanding shares of stock are stock that are still in the hands of stockholders. Let me show you how you get it. So write this in your notes. You're going to take issued shares minus treasury stock, and that will equal outstanding shares of stock. I'm going to have a separate video on what treasury stock is. Right now, this video, I just want you to get how to get outstanding shares of stock. Okay? All right. Next, particulars. Just like when I went over bonds, you have to understand these characteristics. They're just going to throw these into a problem. Here's the next one. Par value or stated value. So within the charter that is at the state, when the corporation incorporates, they have to list what the par value of their stock is, or what the stated value is. So I want you to get par value, stated value, same meaning. That's an arbitrary number that the corporation comes up with that they will issue their stock at. Okay? So par value, just look in the problem. What is the par value? That is the amount you will always credit common stock for. So you'll look at how many shares were issued. You'll multiply it by the par or stated value. Next thing, a corporation doesn't have to have a par value, so they could have no par value stock. What does that mean? That means that they don't have a par value. So you'll see, I'll go over the transactions of when it has no par value or par value stock, how you do that journal entry. Okay? All right, so we went over the terms. Now let's go look at our first practice problem. Here it is. On September 1st, Matrix issued 100,000 shares of no par value stock for $30 per share. Okay, so they don't have a par value. When you see this, it's pretty simple. It's just like your first accounting class. You're going to debit cash. No, my marker's not working. You're going to debit cash for $3 million. And you're going to credit common stock. Okay? That's an example of no par value common stock. Okay, so now I'm going to erase, and I'm looking at your next slide. So work with me on your slides. Everybody have your calculator, have a pen, your notebook when you're working with me. Okay, so now I'm going to kind of erase. I'm going to keep this up. All right, so how do they change? How does the problem change it? Now it says on September 1st, they still issued 100,000. However, change this to $2 par value stock for $30. Remember, whatever the par value in the problem is, will be the amount you credit to common stock. So this one will be a little different than when it's no par value. Well, the cash is still the same. Cash is whatever it's sold for. However, common stock, you're going to find in the problem, it's $2 par value. You multiply that by 100,000, and that gives you 200,000. I'm going to teach you a new account. Here's what it's called. It's called paid in capital. In excess of par. Okay, all it is, again, it's a plug between the difference. 3 million minus 200,000 gives you 2,800,000. Okay, let me step back. This is a brand new account, so you're going to need to make sure you understand. When you work in the lab, it's going to make you figure out total equity. So when it asks you that question, you only pick the accounts that affect equity. Does cash affect equity? Not it by itself. Cash is an asset, so that will not touch equity. Common stock, however, is classified as equity. What's happening in this case? You're crediting common stock, you're increasing your equity. Paid-in capital, that's the new account. That's also an equity account. When you're crediting that account, you're increasing. So you're increasing equity as well with paid-in capital. Okay, so that's an example when it has par value. Again, I'm going to your next slide. Okay, the next slide is an example of an equity. So what it's showing you in this slide is that common stock is $200,000. You got it right from here. Okay. Paid-in capital in this case was $2,000,008. Be careful when you work in the lab. They'll just tell you retained earnings. They'll give you that amount. So watch the problem. Retained earnings wasn't in this at all. They just told you there was a beginning balance. So the beginning balance that I'm showing you here was $660,000. Retained earnings is an equity account. You will include that. And then you just total it. Okay, you total it. And in this case, for the slide, it was $3,150,000. Okay, again, take out those PowerPoint slides. Okay, so now the next one, I'm going to show you an example of a non-cash asset transaction. So here it is. On September 1st, Matrix issued 100,000 of $2 par value stock. However, I'm going to erase this. For land valued at $2,500,000. Okay, so let me step back, make sure it looks good. On September 1st, Matrix issued 100,000 shares of $2 par value stock for land valued at $2,500,000. This is an example of a non-cash transaction. So corporations can issue stock for land. So one party has land, the corporation has stock. The party that has land says, okay, I'll sell you my land. You give me some of your common stock. And when a corporation does do that, think about what's happening. They're giving a piece of their company to that other entity. There are risks in issuing too much stock. If you sell too much, over 50%, another entity can take you over. So you work very hard for your corporation. Be careful, and that's what I would say, when you issue too much common stock, because another entity can take you over. All right, so I'm going to erase this now. It's not going to be cash. So I erase this. It's not cash. What is it now? Well, whatever the land is valued at. An appraiser goes out, they value the land. That's what you put on the books for land. So I put a debit to land because land is an asset. $2,500,000. Okay, watch this. Common stock is still the same. I look at the problem. It's $2 par value times 100,000 shares. Well, common stock is still the same. However, what will change is the paid-in capital. Remember, paid-in capital is always the difference between the two. So the paid-in capital is $2,300,000. Okay, so $2,300,000 is the paid-in capital. Okay? All right, so that's an example of a non-cash asset. Next, I'm going to go over preferred stock. Preferred stock is very similar to common stock. So instead of crediting common stock, you're going to credit preferred stock. However, the journal entries will be very similar, but you're going to look in the problem for the par value associated with preferred stock. So in the example that I gave you, okay, it says prepare the journal entry. So I'm going to erase. It says prepare the journal entry for Stefanini's company issuance. $5,000 shares of preferred stock. Okay? At $100 par value, 6% cumulative preferred stock. I'm going to skip over that in the video because we don't need that. That's given to you for preferred stock, but not when you do the journal entry. So just ignore that. However, I do need for $102 per share. Okay, so let me reread that. Stefanini issuance 5,000 shares of preferred stock at a $100 par value for $102 per share, just like common stock. All right, so you're going to erase this. Cash is whatever it's sold for. Well, it's sold for $102. So now I'm going to take 5,000 shares times 102, and that equals, here's my debit, $510,000. Okay? All right, next thing. I'm going to credit preferred stock. Again, just like common, however, I need to find the par value associated with preferred stock only, so be careful. So I look, what's the preferred stock? It's $100 per share, 5,000 times 100, so my preferred stock is 500,000. Preferred stock is classified as an equity account that will be listed in your equity under equity. The difference between the two is additional paid in capital, P/S, which is preferred stock. Let me erase this common stock. Let me erase this. Okay. Additional paid in capital preferred stock, which is 10,000. Okay, so this is preferred stock. Let me repeat. Debit cash. Credit preferred stock will be listed under equity. It's crediting, it's increasing preferred stock. The difference goes to additional paid in capital, still an equity account. You're crediting 10,000, you will increase under equity. Okay? All right, let me look at my slides. Okay, so I'm going to end the video now because that next slide is talking about treasury stock. I'm going to have a separate video for treasury stock. Okay, so practice the problems from the textbook first before working in the lab. Thank you.